Hi everybody, this week we have 3 interesting webinars lined up for you. First one is on the topic real estate versus equities. So in this webinar, we'll be discussing about the pros and cons of the real estate market and also how you can allocate between real estate and equities. Second one is on good investing at bad times. So here we'll be discussing about investment strategies which can weather all market conditions. Third one is on will the US elections impact the stock market? So if you are someone who is confused on how the markets will react from here, do tune into this webinar. All the registration links are given below in the description. Do check it out. Hope to see you all there. Thanks.
For one of the earlier answers, you mentioned that deploying capital from time to time is important. It is true that deploying capital when opportunities come our way is going to add to your returns. But the next question I'm going to ask is for somebody that has limited capital. Let's take a retiree, for example. So a retiree, should they consider a PMS or are they better suited in a mutual fund product?
Actually, I have created a PMS only for retirees. It's a multi-asset product called Sphere. When I thought about this product, I thought about people who will need money every month. So when we curated the product itself, we said no exit load. You can put in money anytime, you can take out money anytime as long as you maintain 50 lakhs. But imagine you are a disciplined investor who has put in capital which is significant and you are only going to take the monthly money that you need to run your life. Right? And the portfolio generates better than the anticipated return. Then the portfolio itself should generate fresh capital for new ideas. That is the concept. Suppose you come into some money and you are able to add some money, then the portfolio goes to the next level. So the portfolio has certain traits and characteristics. There is a certain premise on which the product is created, and the product will always serve that premise. So it's not as if a retiree should not invest in a PMS. I have multiple clients who have invested in this who are retirees. The only point is he should be careful about where he is going to invest. He should not invest in the highest risk zone of the market where you can have 70-80% drawdown. He should not do it. Or he should do only a small part of his portfolio which won't affect his quality of life at all. But if you are having limited resources, you will stick to the safe zone and stick to products which give you lower volatility, inflation beating, satisfactory returns and very good ownership experience. PMS can give that because understand one thing, PMS is only a license. Tomorrow I can run a debt portfolio for you in a PMS at a very low cost. The license is only an enabler. It is not true that all PMS products are high risk. In fact, in our ecosystem, we try to avoid creating high risk products. We want only moderate risk to low risk products. So we are not interested in saying that we are high risk managers or believing ourselves that no, we can drive the product at a crazy pace. We are not in that game. But there are many people who are only in that game saying that I will generate the highest returns. I have no view on others. In my opinion, PMS license should be used responsibly to meet the needs of anyone who is a moderate risk investor, including retirees. That is the simple point that I want to make here.
Okay, great. So when you look at a mutual fund portfolio, people look at diversifying across 3-4 funds because each fund has a different strategy. But most times PMS investors don't consider this. So since you mentioned Sphere is one of your funds, let's also touch upon your other funds. How does you run multiple funds? So how does pairing PMS products help an investor?
So pairing is a very powerful concept which we have created in iThought. What is this meant for? Now there are different needs of every person. Let's say a retiree has 2 needs. I'm just going to give a retiree's example. He has 2 needs. One is he needs money to run his life. Other is he needs money to leave behind for his children or for those who are his descendants. Sometimes people leave money even for grandchildren. Now the money he needs to run his life may be something that is constantly required, so the risk profile of that product or the risk appetite of the customer may be very moderate. So for that he needs a product. So we have a product like Solitaire where it's a moderate risk profile but pure equity. But suppose he wants money monthly, which is what a retiree needs. He needs more than even just a pure equity product. That is why we created the multi-asset product called Sphere. So Sphere will be the primary product for the retiree. But I told you he also wants to leave behind something for his descendants or family members. He can always do a Solitaire as a second product. Two products paired together. One product where he is confident of meeting his regular financial needs whenever he needs, which is a multi-asset. The other product which he is not going to touch at all, which he may also add up and top up over a period of time. So when you pair these two products, one product meets one requirement, other product meets the other requirement. So whenever you pair two products, they help you achieve multiple objectives. You can have even three. So in my opinion, the small cap product like Vriddhi comes into play when you have very patient capital, which you will not touch, and where you want to take some risks so that it raises your overall return significantly, where you want to have very sensible small cap and mid cap investing, largely small cap investing. So suppose you want to do that and you start when the valuations are reasonable, you are sure to succeed in that. So you can take that and pair it with one of the other products we have, where you take a lower risk approach and your approach is never going to give you sleepless nights. So when the market is down, when you go and buy a small cap, it helps you to participate in a space with a lot of promise. At the same time, not get caught because you started at the wrong time. So an investor must know when to pair these products and how to pair these products and how that pairing works to meet his personal objectives. That he has to understand from us. To understand that from us, he needs to explain himself adequately to us. And only then we will be able to give him the right product solution. So pairing is a very powerful idea. Like I have paired a Solitaire and a Vriddhi personally. Because I am not now thinking of retirement yet. So I chose pure equity for both the products. But suppose I want some money to come my way regularly for some activity, it could be philanthropy, it could be something, then a multi-asset will be extremely good for me. Then I will start a multi-asset and grow that portfolio. So when my objectives are different, I choose a product to meet and fulfill my objective. So actually if you notice, the product has been built around objectives so that it satisfies the objectives of the investor. And if he has got multiple objectives, then he can have more than one product. And when he pairs two products, it works very well. Even from point of view of deployment, you cannot invest in some products all the time. Today, Solitaire doesn't have capacity to take in capital much, but multi-asset is able to take in any amount of capital even today. So if you want to keep on investing every month, then you can invest in the multi-asset when markets are like you see in the present. And then when the markets correct a little bit and Solitaire starts seeing opportunities, you can give Solitaire money. So the flexibility to invest is also high for an investor when he does pairing. That is why pairing is a powerful idea.
When comparing a mutual fund to a PMS, a question that commonly comes up is the tax efficiency of a PMS. So in a mutual fund, the investor is taxed when the mutual fund is sold and the mutual fund units are ultimately sold. In a PMS, the investor pays every time there is a transaction in the portfolio as well as for dividends. So for an investor, is there merit in looking beyond this point and considering a PMS?
I think these are generalizations. Now, if suppose a mutual fund scheme has a churn well above 150%, right? There are many schemes which have such a high churn. The impact cost which that mutual fund scheme is creating when it keeps changing its portfolio is probably as high as the rate of long-term capital gains, which goes unnoticed. You know why it is going unnoticed? It is going unnoticed because we have had a one-way market for the last 4 years and such indiscipline which creates impact costs is getting washed under the flood of a rising market. right? Now, suppose you are running a PMS product where your churn is 20%. Your tax is only going to come on the 20% of the portfolio and not on the 100%, which makes it insignificant. Now, if the PMS portfolio is beating the mutual fund by a wide margin, then obsessing over taxes is going to blind you from investing in a far superior product where your tax adjusted returns are superior. So, I think that you need to have a very granular view of a product, be it a mutual fund or a PMS, and compare them on the same metrics. Now, if you are going to compare them on an industry-wide metric which you are assuming, because I think the PMS metric is also assumed and the mutual fund metric is also assumed, I think it is only comparison between two assumptions and not between two products. I would like people to do that comparison between two assumptions because that is what affects you. If you compare two generalizations, then you are making a bad judgment. Be very specific, make your comparison and arrive at your own judgment on a post-tax basis. Okay. Because the churn will tell you what will be the taxation in a mutual fund. And the same churn will tell you what is the impact cost in a PMS. So, I think these two basically kind of, counter each other. And low churn always wins.
Clear. All the previous questions have been a comparison between a PMS and mutual fund. So now let's move beyond and look at another asset class. There is a famous Tamil saying that goes, Mannum Ponnum Mosam Pogadu, which translates to real estate and gold never goes bad. You've been an active advocate of gold and silver investments around this time. But how do you see real estate versus PMS?
See, as things stand today, I think the future prospect of real estate from the current prices is not very rosy. Real estate should be bought when the cycle is at the bottom, when there is huge supply and the demand is soft. Today I will tell you, the supply is being controlled by various forces in different places. I think largely politically controlled. And the demand is very high because everybody thinks that they can book an apartment, it will get ready in 5 years and pay only EMI. By the time it is completed, they can sell it, pocket the difference and go. Which means there is a trade going on in real estate which is based on the limited supply. Now, suppose supply increases by 3x by the time your delivery comes. A lot of people who are holding on to these positions which they are hoping to trade out may be sitting on a notional loss. This happened in Chennai in one of the most prominent markets. OMR, at least about 7-8 years ago, if my memory is correct. And it will happen everywhere actually. See, because the builder is not an idiot. If he sees a demand growing and if he can supply at a much higher price and pocket that difference, why would the builder leave that to somebody who is making a booking and paying some installments? He will try to pocket that. I think in real estate we are heading towards that phase very clearly. Now, each market is specific. For example, Gurgaon is one kind of market, Pune is one kind of market, Bangalore is one kind of market, Chennai is a different market, Coimbatore is a different market, Bombay is a completely different market. So each market is different. But I would think that in the coming years, supply is going to surprise those who are speculating in real estate by making bookings. And when supply shocks them, they will stare at losses. This is the universal rule in real estate because everybody looks only at demand. I think you should look at supply, and the risk to speculating in real estate today comes from supply.
So since we're at the topic of another asset class, let's also look at a new asset class that is evolving. So India's investment landscape in general has been evolving. SEBI recently introduced this new asset class, which they've placed between a mutual fund and a PMS. The entry size is 10 lakhs. What do you expect from this new asset class?
See, the point is the mutual fund already has an array of products. We'll have to see what they do differently in this product, whether they are able to differentiate and create a product. If you see the kind of product differentiation which has been allowed so far in mutual fund, we have had actually a reverse process. It has been regressive actually. Earlier, we were able to call a product anything in a mutual fund. do a lot of things. But now all products are named the same way in the name of categorization and simplification. So there is no differentiation in the products of a mutual fund. Mutual funds have moved away from building differentiated products. Now suddenly we are telling them we'll give a new category, now you create differentiated products. Let the products come. Do mutual funds still have the DNA to differentiate and market, or have they surrendered it? We'll have to wait and see. But I would not rush to conclude anything on the future of this product. Though I feel that opening it only to mutual funds and not to other regulated entities may be giving some kind of an unfair advantage to mutual funds for some period of time. But there's no guarantee that they'll create great products. We'll have to wait and see.
Okay. At what stage during an investor's journey should they start looking or considering asset allocation? Should it be from the beginning, or does it evolve over a period of time?
I think it should be from the beginning, but it should gain more importance as they age. In the beginning, you will have an equity heavy portfolio with some money for a contingency, some money for emergencies, some money for some future commitments. So it will be predominantly equity driven. And as you see market cycles, you should learn to invest in other assets. As you age more and more, you should learn to balance your allocations across assets. And you must be very nuanced in how you balance these allocations, which means that you must know asset allocation much better as you grow older, but you must start early. That's the broad construct of asset allocation. It is generally a myth among a lot of people saying that, oh, I'll do that when I become old. It doesn't work that way. It has to grow on you. Suddenly, you will not get the competence to invest in multiple assets. You can be a damn good equity investor and a lousy investor in gold and real estate. It's very much possible. There are a lot of such lousy investors. So, to be a good investor in all asset classes, you must learn asset allocation early. You must practice it from an early stage. And you must get used to doing asset allocation in your portfolio. Only then you can do sensible asset allocation.
Somebody that does not have real estate, what kind of goalposts or aspirations they can set for themselves?
As real estate valuations look in the present, it is extremely overvalued. Assume you don't have real estate. You will have to build your capital, which will go into real estate. I would think somebody should keep building their capital to be invested in real estate in a separate silo. Allocate money separately for that. Grow that money to an extent that at some point you will develop confidence and comfort between how much capital you have to invest in real estate, which is ready to be invested. What is the valuation scenario in real estate? Do you like the values of property? Would you like to buy at these valuations? And when these two kind of look very comfortable to you, at that point you can go in for a purchase of a real estate for your future consumption. And when you do that, make sure that you have a significant equity in the asset that you buy, and you are able to repay the banker in a shorter time frame, maybe 7 to 10 years. Then what happens is that you have lot more of your resources available to grow by investing aggressively in other asset classes like equity. Whereas if you take a larger loan now in a hurry and buy real estate at an elevated valuation, then you end up channeling more of your future savings only to repay this loan. So the decision itself makes the cost of your asset very much higher, and it eventually becomes a very costly decision. When you make a real estate decision from here, make sure that it is not a costly decision. And even that decision is largely paid off by a significant part of your money and a balancing part of debt. So keep your debt under tight check and ensure that that debt also is paid off within reasonable time.
Okay, let's take another case. This is again an equity heavy portfolio, but it forms their normal equity like mutual funds and their PMS, and they also have ESOPs that are given by company. If you take the younger generation or the new gen workforce, in startups, they are offered lots of ESOPs. So it ends up being a large portion of their overall portfolio, overall asset class itself. So how should one manage their ESOP?
I think ESOP is not a one-time thing. You do get vesting of options continuously. So you can have visibility for 2 to 3 years. When you know you are going to get more ESOPs down the road, you can make use of elevated valuation in your company stock price to lighten yourself and stay prepared for the next round of ESOP. So what would happen is, suppose you are holding in X company, ESOPs to the extent of 30% of your financial assets today. It grows to 45% in 1 year. So you can reduce it from 45 back to maybe 30. And you are again going to get another 5 or 10%. So you can actually reduce it even lower to maybe 25 or even 20. And that money that you are reducing should be repurposed correctly. It can go to repay a home loan. It can go towards building a specific wealth corpus. It can go towards strengthening your retirement corpus. It can go towards education or marriage of your children. So basically, you will specifically purpose that money. You will not put it back into one broad pool in which you cannot identify that money. So the money should become allocable. You must be able to allocate it. Identifiable. You must be able to clearly say where it came from and what its present worth is. And you will also be able to grow that capital. So it should not be that you got ESOP, you didn't handle it properly. The 100 rupees that you got as ESOP, finally you took it at 70 rupees. You should make that 100 into maybe 200 or 400 over long periods of time, for which you need a very disciplined approach. So you cannot sleep over your ESOPs without doing anything, nor you should be rash over your ESOPs by indulging in hasty selling. You have to strike a balance between these two things.
Now we're going to come back to you. So you have been an investor in 3 of iThoughts PMS products. What would you like to share from an investor's perspective?
See, these products are all created with an objective that the investor should not bother too much about what is happening. One. Second, he should be able to add some money whenever money is called in by the manager. Third, he should be able to scale this project to a significant size. I think that we have scaled these products wherever we are investing to a reasonable size today, and we are continuing to grow that size. That's a positive aspect of what we are doing by investing in our own PMS. I think that that comfort is something that's very important for all our investors. And as an investor, I am checking all the time whether I have that comfort. So I don't take any money out first. Whatever money goes in stays. The second thing is that I do try to add some money whenever I find liquidity. So I also continue to participate in the product. These are all what we ask out of our investors. And I also set a very large corpus target for each product I invested in. It means it will keep going until then. And maybe after that I will evaluate whether I can take out the surplus. But that's a very distant thing. It's not imminent. I continue to invest.
Okay.
So I am confident of continuously investing across market cycles. We have already done 5 years and grown to a reasonable size in both the products. We have invested from the beginning. The third product also is just gaining momentum. So we will continue to keep doing this as an exercise.
Okay. So you are an investor and you are also a fund manager. So these are 2 separate portfolios, right? So let's take another investor. Let's take, for example, me. I like investing, but I would also like to go for professional advice. So how should I balance my own portfolio and a professionally managed portfolio?
See, the amount of effort which an individual investor needs to put to create a portfolio that is sustainably performing is huge. You have to work every single day. You have to be abreast of a lot of developments. You must be knowledgeable. Your knowledge should keep growing year on year. You must have your ear to the market, ear on the ground, and you must also have a nose for the right ideas, and you must be able to stomach failures. So your temperament should be exceptional. If all these things are there, being an individual investor has merit. But suppose you are the type who has no time to look into your portfolio, you have a lot of constraints in terms of compliance, because if there is a portfolio of stocks that you have, and there are stocks which I thought is buying, then you will not get permission to buy. In such instances, better for you to be a part of the PMS and get yourself to participate in a lot of ideas which you cannot buy. Makes sense. And you will also have a variety in management styles. For example, when I invest with other managers, they give me variety in my portfolio. They do things which I don't do, which I would otherwise ignore, and they do succeed at it. So by giving money to others, that is the advantage you get.
Okay, now
otherwise it's just your thoughts and your capacity, your ability to succeed, or your tendency to fail. It could be anything. So to de-risk yourself only, you give it to a professional and you focus on your work.
Okay. Now we're going to speak about changing views. So as an investor, it is necessary that we have to change our views based on market landscapes and how businesses are evolving. So if you had a certain perception about a business, would that change over a period of time?
Certainly will change, because the market context changes, economic context changes. Many of the companies that I have been very bearish turned out to be future investments later, because as the context changed, the economic circumstances changed, the company also changed, its fundamentals changed, they became very attractive, and the company then once again seemed poised for growth. So I would get back in. So when everything changes, you change accordingly. You don't be stuck up on saying, oh, I told this stock is not a great company 5 years ago, I have to justify my position. That is not our job.
Okay. A short question about iThoughts PMS. Who should opt for iThoughts PMS?
Anybody who wants to be a serious wealth creator, somebody who wants to create a wealth corpus of $1 million or more. See, if you go to a private wealth company or a bank, if your wealth is above a certain level, everybody is interested in you, because you have a corpus. But what differentiates iThought is we are interested in building that corpus for you. We are interested in working with you to build that corpus. Suppose you already have that corpus. We want to manage that corpus for you in a manner very different from how it was managed earlier. And we want that corpus to be managed by a process that gives you a lot of comfort and you don't lose peace of mind nor a wink of sleep. So these are our internal priorities which we have written for ourselves, saying that we are getting into this to serve this kind of an investor. And when we successfully serve such investors, it just keeps going. So our mission would be to add customers who see this future for themselves. We are not looking at 1,000 people giving us 50 lakhs. We are looking at whoever has given us 50 lakhs, becoming more serious about it and taking the 50 lakh up progressively whenever we call in money. Which means that our game is more serious than the others, where they are looking at money as fungible. If one guy goes, another guy comes. So they don't mind clients leaving, they have new clients coming. We are not in that approach at all. We want it to be controlled much better. And we want to give the experience which gives people the confidence and comfort. And we want to make them stay longer so that they achieve their financial goals. And that's what completely differentiates what work we do from the work done by, let's say, a bank RM or even a private.
We'll end the session with 3 expectations that an investor should have in this market.
Expect that global markets will correct. Expect that the Indian indices will correct. Expect a crisis in overvalued parts of the stock market in the coming year. These are 3 things you should not forget and you must expect.
We have more questions and more insights to hear from Shyam. Stay tuned.